All right, let's dive right into this explainer and run US Physical Therapy, that's ticker symbol USPH, through the absolute ultimate investment gauntlet. You see, finding a great company is really only half the battle when it comes to investing, right? The other half, and honestly the much harder half, is paying the right price. So today we're going to look at the raw data and perform a complete stock analysis using some of the most rigorous financial frameworks ever created.
Here's our roadmap for today. We'll start with a quick USPH snapshot, run it through the Buffett, Lynch, and Graham lenses, map out a DCF and alternative models, and then wrap up with our synthesis verdict.
Okay, Part 1, USPH Company Snapshot.
So, to set the stage, US Physical Therapy is one of the largest, pure-play, publicly traded operators of outpatient physical and occupational therapy clinics out there. They're operating 795 clinics across 45 states, which is massive. But how do they actually grow? Well, as a major player in what is a very fragmented market, USPH relies heavily on strategic acquisitions. In fact, if you look at a recent SEC 8K filing, they just scooped up a 67% equity interest in a new 12-clinic practice, leaving 33% to the original owners. That partnership model, that's a core tenet of their entire business strategy.
Now, as of the data we're reviewing, the stock closed at $71.59, giving it a market cap of about $1.09 billion. But listen, as analysts, we don't just blindly look at a price tag. We need to know if that price is actually justified by the underlying fundamentals. So, let's start the gauntlet.
Moving right along to Part 2, the Warren Buffett lens.
Right out of the gate, USPH's return on equity is kind of a major sticking point for us. Warren Buffett absolutely loves capital efficiency, and he generally looks for an ROE consistently above 15% to prove a company has a real economic moat. USPH sits at just 6.79%. This basically tells us that while they're definitely profitable, they just aren't generating massive returns on the capital that shareholders have invested.
Looking a little deeper at Buffett's checklist, well, it's a bit of a mixed bag. On the plus side, the company has a very manageable debt-to-equity ratio of 0.41, which Buffett would definitely appreciate. They also generate a totally decent 6.12% free cash flow yield, which aligns nicely with his concept of owner earnings. However, the economic moat is, frankly, pretty tricky. Yes, they have scale, but physical therapy is highly fragmented with incredibly low barriers to entry. Combine that with the super complex accounting required for their non-controlling interests, basically dealing with the shares of clinics they don't fully own, and Buffett would likely just keep waiting. Without a high ROE and a much wider margin of safety, this just doesn't look like your classic Berkshire Hathaway purchase.
Okay, Part 3, the Peter Lynch lens.
So, what about Peter Lynch? The legendary former manager of the Magellan Fund famously looks for growth at a reasonable price. He definitely categorized USPH as a stalwart. These are those large, established companies that grow steadily and usually offer a nice dividend, and USPH currently pays a 2.5% yield. The growth is for sure steady. Their recent Q1 report showed revenue up 7.9% to a record $198.3 million, driven largely by those constant clinic acquisitions we talked about. But remember, Lynch absolutely demands a fair price for that growth.
But here's the massive hurdle for Lynch, USPH's PEG ratio. This metric takes the price-to-earnings multiple and divides it by the company's growth rate. At 2.03, USPH is way above Lynch's ideal buy signal of 1.0 or lower. Even with a strong balance sheet and steady expansion, a PEG over 2 screams that the stock is just too expensive for its current growth rate. For Lynch to even be interested, the price would literally need to drop in half to align with its actual earnings growth.
Next up, Part 4, the Benjamin Graham lens.
Now, the godfather of value investing, Benjamin Graham, literally does not care about your narrative. He wants a strict statistical bargain. And going through his defensive investor checklist, the results are pretty stark. USPH passes on adequate size with that $1.09 billion market cap, and they certainly have a consistent dividend record. But man, it completely fails on his liquidity and valuation limits. Graham wants a current ratio over 2. USPH is sitting at 1.19. He wants a moderate price-to-earnings ratio below 15. USPH is carrying a staggering 141.76 PE ratio. And their price-to-book ratio, also too high at 2.32.
So let's just do the math. Graham gave us this legendary formula to calculate intrinsic value. We multiply his benchmark, which is a super conservative 22.5 by the way, by the trailing earnings per share of 50 cents, and then by the book value per share of $30.85. Finally, we take the square root of that whole thing. Let's see what the calculator spits out. And wow, the resulting fair value is a downright shocking $18.63 per share. With the stock trading around 71 bucks, there is absolutely zero margin of safety here. In fact, Graham wouldn't even look twice at this stock unless it dropped by over 70% from its current price. It's a definitive fail under the strict Graham value lens.
All right, part 5, DCF and alt models.
Okay, so the classic gurus are essentially out. Let's pivot to some modern quantitative frameworks. We're talking building a discounted cash flow model and running the dividend discount model. To build our base case DCF, we have to forecast future free cash flows and calculate a terminal value. Now, because the source data doesn't supply a specific cost of capital, we're explicitly assuming an industry average weighted average cost of capital, or WACC, of 8.5%. For the terminal value, we're using the perpetual growth method, assuming a GDP-aligned perpetual growth rate of 2.5%.
So if we project out their current $66 million in free cash flow using that 8.5% WACC and 2.5% terminal growth, our base case DCF yields a fair value of roughly $65 per share. And look, even if we tweak the cost of capital down to 7.5% or bump growth up to 3.5%, the value only ranges from $50 to $85. With the current price sitting at 71.59, it's hovering dangerously close to the absolute high end of our reasonable estimates. That leaves very, very little margin for error.
And if we apply a couple of other models, it pretty much just confirms this expensive valuation. The dividend discount model, which values a stock purely on the net present value of its future dividends, gives us a target of just $34.45, assuming a steady 3% dividend growth rate. On top of that, their enterprise value compared to EBITDA sits at 13.87. That is historically a bit above the sector average, which confirms to us that the market is already pricing in a hefty premium for USPH's stability.
Which brings us to part 6, our synthesis verdict. Bringing all this data together into one master scoreboard, look at the alignment across these frameworks. Almost every single valuation model, from Graham's ultra-conservative math to our modern DCF, suggests the stock is currently overvalued at 71.59. Graham is screaming strong sell. The DDM and Lynch models suggest a sell unless the price literally halves. Even our most optimistic base DCF pegs the fair value around $65. That makes it a definitive hold at best for current owners who just want to collect the dividend, but a clear sell or avoid for value-seeking investors looking to deploy new capital.
So ultimately, you have to ask yourself the really hard question here. Are you willing to pay a massive premium today simply for the safety of a 2.5% dividend and slow, steady healthcare expansion? Look, U.S. physical therapy is undeniably a solid, growing business with a massive clinical footprint. But as our gauntlet has proven today, a great company absolutely does not equal a great stock if the price isn't right. Keep these frameworks in mind next time you evaluate a steady stalwart in your own portfolio.